Welcome, everyone, to our Winning and Winner regulatory updates. I'm going to turn it over to you, Mark, to do some introductions. I know we'll go to the next page of the slide.
Next slide.
We see you able to
There we
click
go.
click the page. There we
There
go.
you go. Yeah, so my name is Mark McCardle. I joined Newrez last year. Before that, I spent 7.5 years at the CFPB. I like to say I spent 7 years there, and I had seven different directors, including three directors in 1 week, the final week, where it was Rohit Chopra in the beginning, Scott Besson in the middle, and then Russell Vogt at the end. Before that, I was at Treasury doing a lot of the TARP stuff, so HARP and HAMP and all those H programs that came out after the last great financial crisis. I'm very happy to be here, and we got a lot to talk about because it's a crazy time in DC. And Don can introduce himself.
Yeah, Mark, you've got a ton of experience, especially the stuff that impacts the mortgage business. So we're looking forward to spending some time together, especially at TARP. But as you guys can see, I also recently joined Newrez as division manager over all of the wholesale and non-delegated correspondent. I have 35 years in the business. I've seen a lot of changes. Obviously, my most recent time was with Rocket Pro TPO, also with HSBC. I'll share some of the things we hope you get from this. So I've seen many changes. The mortgage business has been a resilient space. As long as you stay informed, and that's what we're going to do today, is hopefully inform you on all this stuff, and you have the ability to adapt. This business has got a lot of adaptable folks out there. So remain involved. I'm looking forward to the conversation we have today and kind of answering your questions on both, whether it's broker or wholesale or however we, are facing some of the changes that are coming up. So turn it back over to you, Mark, as we kind of jump into some of the things.
And for those, my background is the ice planet Hoth, which I think is probably suitable for those of you who are in the third of the country that's covered in ice, which includes my home state. All right, so we'll talk a little bit about federal housing agencies. We'll talk a little bit about Congress. We'll talk about the government shutdown, but we're going to start with the federal agencies and what's going on there in the last year and what we think is going to be happening there. So I listed these agencies in alphabetical order, but it's helpful to talk about them in sort of the order in which they're impacted by this change. I've spent 15 years in DC, and this is the most like dramatic changes I've seen in the federal mortgage space, at least among the agencies that sort of regulate since at least Dodd-Frank. My agency is number one for impacted. It obviously was a big, huge 3,000-pound gorilla in the mortgage world, and it is now, I don't know, a kitten. They've been threatened with multiple rounds of layoffs. Up to 80-90% of staff have been threatened with a layoff. It has produced rules, including the recent ECOA rule that came out. But whether it's able to do future rulemaking is still in doubt. The current status is Jeff Gradler is the deputy. He would take over in August when Russell Vogt is the acting director of the agency. And there's a few other folks there. On their agenda is very aggressive. It includes things like LO comp, QM changes, the ECOA rule that they released. Servicing is on there at least twice. But whether they'll be able to do this agenda, it very much depends on whether they're going to still be, active and around and how many folks are still in their seats. So that's going to be an open and interesting question to watch. And we'll talk a little bit more about that. Another agency, number two for most impacted, is FHFA. That's the one that oversees the Fannie and Freddie. So Pulte took over in March, and it's been a roller coaster ride since then. There have been changes to both GSEs, how they've been led. There's been obviously the credit score changes. They announced that they'd be using Vantage Score, and though they haven't been able to implement that yet, there've been talk about releasing the GSEs, talk about an IPO for the GSEs. So there's a lot of open questions there. Also, the way they work is totally different. It used to be that FHFA would operate more like a normal regulatory agency. There'd be rules, there'd be requests for information. Now it's often tweets, and you see FHFA reacting sort of after the fact to sort of like the Vantage Score thing came from a tweet, and then you saw FHFA try to like paper over the tweet later. So it's a very sort of chaotic process. The other agencies have been less impacted. FHFA, FHA, and VA are sort of they have a more orderly transition. There are people we know in place there. Matt Jones came from MBA, and he's a DAS over there. Frank Cassidy used to be in the multifamily space. He's the commissioner, and they haven't made any. They've rolled back some of the Biden rules, but there hasn't been, more or less, FHA loans are continuing as normal. They've made substantial changes on the servicing side, but many of those were started in the last administration. So it's more or less consistent. VA, John Bell used to be the leader there, and now it's Patrick Zondervan. They're working on a partial claim program that Congress gave them the authority to do. But other than that, they are also chirping along. And finally, Ginnie Mae is run by Joe Gormley, who's another person that a lot of us know in the mortgage industry. Their biggest issue is they're working to create loan level accounting so you could sell delinquent loans on the Ginnie side. They're also seeing if they can create a way to make financing of Ginnie advances easier. There are questions about whether they will ever do anything around the advances. Ginnie is different than the GSEs where you have to advance endlessly. I didn't put this on here, but USDA is probably the least impacted agency. They do a lot of good work, but they all the same people are in place. Ingrid Ripley and Rich Kane and all the folks that are still in place, and that agency keeps on going just like they were going. So that's good news. Though I put a little link there. There's a rumor that they might try to move him to HUD, which would be an interesting thing to watch. So that's all on this slide. Next slide.
So what's interesting, Mark, and I know you covered a lot of them there, but some of them, as you're showing here, are moving at a feverish pace. So one, neglected on my part, but if you're listening, at the bottom of the screen, there's something that's called Q&A. If you click on the Q&A, you can always ask an open question as we're going through stuff. But that's where I want to kind of start digging into all these different agencies. And go ahead, Mark, as you have on the screen, there's just a feverish amount of information coming out.
Yeah, so I do talk fast too. It's my Chicago roots, but feel free to ask any questions and we'll have, of course, time at the end. I just wanted to dig deeper in two of the agencies, so CFPB and FHFA. So CFPB here, just wanted to highlight some of the highlights that are on this slide. So yeah, they started with Rohit Chopra being fired on February 1st. Scott Bessent was on February 3rd, and by the end of that week, Russell Vogt on February 8th came in. They immediately tried to basically stop all work, and there was a lot of talk about firing staff. You see that in April that they announced that they gave out actual firing notices to 90% of staff. That was stopped by the courts. It is still in litigation. So right now the way it goes is the initial judge ruled against the administration and said you can't fire everybody. A 3-court appeal court said, "Oh no, you can fire people." It was appealed again to on the full circuit, the DC circuit, which hasn't yet ruled. They'll start doing hearings at the end of February. The odds-on bet is that they're going to win that. The CFPB will win that case, and the administration will lose that one, and then it'll be appealed to the Supreme Court. And if the pattern holds, the Supreme Court will probably let them fire a good chunk of staff if that's still what they want to do when that gets there. But given it's no longer on an emergency docket, it could be until 2027 before that ruling comes down the pike. So that's just something to watch. Some of the other things on this slide is you can see that they nominated a new director, Stuart Levenbach. That was just a placeholder to give Russell Vogt another 210 days as acting. The biggest mortgage thing released is that they did release the ECOA proposal that rolled back disparate impact. Many of you know about the Townstone case that they did. So basically that ECOA proposal was targeted at that and sort of dialing back what they consider to be the excesses of previous interpretations of ECOA and disparate impact. And right now, as we see, the last thing that Russell Vogt did at the end of the year was basically said, "I'm not going to withdraw. I believe that the Fed is running a deficit. I can't make a draw." The courts intervened and said, "You must make a draw." And he did do that. So the Bureau is funded all the way through this quarter, and probably there'll be the same logic will apply, and they'll be funded next quarter. Next slide. All right. Now, the next agency is FHFA, and that's been a real, like I said, roller coaster ride. Bill Pulte was nominated and confirmed on March 13th, and he made broad changes to the boards, including putting himself on both boards of Fannie and Freddie. That was unprecedented. He then fired some execs at Freddie Mac. And also at FHFA, they did widespread layoffs. On April, he said he's done making changes at the GSEs. That's not quite exactly what happened. They talked about taking them public, which that first was announced in May, and they said they'd do it by the end of the year. That obviously didn't happen. Vantage Score, that was announced in July that they would accept Vantage Score 4.0 immediately. That still hasn't happened. We'll talk a little bit more about credit scores later, but that's the credit score debate will be one of the interesting things to watch in 2026. Uh, Later, you see that they fired the Fannie Mae. Priscilla was she went away, and they named Peter Agaba as the new CEO. And there were also the talks about what's going to happen with a 50-year mortgage. And then finally, the last thing is that they were directed to buy $200 million in MBS, billion dollars in MBS to help push down rates. And we'll talk a little bit more about that later, but it'll be interesting to see if that actually has much of an impact. I'll pause if there's questions, but otherwise, next slide. Okay, next slide. Congressional update. So there's been a number of things coming around the pike here. First, we came off the longest shutdown in history, 43 days. USDA and the federal insurance program wasn't able to issue policies. VA was also, and HUD were all impacted. It was, as you all know, a very chaotic time. We have another shutdown right around the corner. That's going to be a little different because both USDA and VA are exempted from this one. They have already got their funding bills funded. There are 6 bills left. Unfortunately, that does include the flood insurance program as well as HUD. So HUD, as you noticed in the last shutdown, was still able to do FHA loans. That'll continue. But if you have questions, if there's problems, some of the back operations of HUD will be impacted with the shutdown. This is mostly about DHS and what's the tragic events that happened in Minneapolis. So it'll be interesting to see what happens there, how long this lasts. But the 2 biggest impacts on mortgage will be the flood insurance program and on the HUD staff to see how much hopefully HUD is trying to make some changes to their program that they're trying to get out this week. And hopefully they'll do that mostly on the foreclosure side where they're trying to make changes to their program. The trigger lead law, that affects most everybody on the call. It'll be effective March 5th. That's 180 days after enactment. And it prohibits the 3 credit bureaus from selling information after the credit pull unless they, A, have given explicit consent and opt in. The previous one was an opt out. Or the recipient has an existing financial relationship with the institution, e.g., their current bank, their current servicer, the original lender, etc. It amends the Fair Credit Reporting Act, so it's enforced on the federal level by the CFPB and the FTC. But states and private litigants also can act here. And we'll talk more about private litigants because they're pretty much everywhere. And finally, the biggest question in DC is what will they do about supply? Both the Senate and the House have passed bills. The Road to Housing is in the Senate version. It passed unanimously. It was very broad. It had 41 different provisions. The House passed its own thing called Housing in the 21st Century. It's much more narrow, but many of them having some of the same things. Zoning reforms, sort of a model zoning code. Streamlined environmental reviews are part of both of them. Efforts to encourage manufactured housing, incentives to build by transit. Many of the provisions are sort of optional or provide incentives, but I'm not sure it's going to dramatically change the landscape in supply. But most people think it's helpful and welcome if they could get that passed, and also symbolically important given that the supply is the #1 issue facing most home buyers in this country today. Next slide.
Mark, before we move on real quick, Mark,
Yep.
you have any opinions on the 3/5 date and when we will first possibly start seeing any action from the rule going into effect, or
Well, I mean,
to be
hopefully everyone is.
determined?
The Bureau should be fully, they should have already implemented the controls to stop selling these rules unless you can prove you have the existing relationship. So I think hopefully you'll see the impact almost immediately. And I don't know, many of you might have known, I mean, I've refied in the last 5 years. The number of calls you'd get is ungodly. You'd get, dozens upon dozens of calls if you didn't opt out. So that will reduce some of the noise, but it also make sort of a different environment for lenders because to navigate.
I just think you see sometimes those different agencies have different times. Like I think private litigants probably take a little bit longer to develop because they need to see violations and complaints where the CFPB or the maybe less funded, and so it rolls to the states. And so I know you're going to chat a little bit more about the states later, so we'll pause that.
Yeah.
I don't know if you agree with that statement.
Yeah, and one interesting thing is I agree entirely that the federal level is usually first to operate, but even though the CFPB, its status is a little bit in the question, FTC has actually been very active. So I think if you started to see sort of violations of the trigger lead law, and given that it had bipartisan support, I think you'd see the FTC act on the federal level. As I said, states, especially certain states, could be very active here. Some states passed their own version of a trigger lead law even before the national one came into place. Idaho, several others, red, blue. This is a pretty bipartisan issue. So I think if people started getting calls and complaints if the trigger lead law didn't work as implemented, you'd see action pretty quickly. And it is something that the three bureaus can control because obviously they sell the information.
And is there any one thing on the housing road that you see? Like, seems like maybe zoning reform is going to be maybe the biggest because all these other kind of ideas that keep coming out only would drive more prices up. If you don't have supply, you run into a
Yeah.
problem.
And that's the problem with even the GSE proposal to buy MBS. Everyone's fixated on rates and what can we do to lower rates, and that will help the refi market especially. But if you lower rates and the supply remains the same, obviously the prices start to accelerate. That's what happened during the pandemic. There's quite a lot of evidence coming out from the Federal Reserve's quantitative easing that helped push prices up faster. So that could make affordability actually worse long term. So I totally agree that there's too much fixation on rates and the supply is where it's at. But obviously, it takes longer to fix. It's jurisdictions across the country. The zoning reform is more like a model, but there might be like certainly the federal environmental streamlining that could help a lot with development. So we'll see. I mean, I think this is an area where a critical mass is building, where more and more people are saying, where are my kids going to live when they grow up? So I'm hopeful that we'll start seeing this go because it is a bipartisan issue where both Republican, Democrat, everybody says we need more supply out there.
Agree.
All right. Now, Trump executive actions, we've talked about these a little. So there was the big Davos speech, and people were expecting a lot of things to come out of that. It was interesting to see that actually less came out than initially we suspected. The only two things that really came out were things that were floated before, the 200 billion in MBS that we talked about. As noted on this slide, it's way smaller than the Federal Reserve's effort. The Federal Reserve bought somewhere north of $1 trillion in MBS, closer to 1.4 trillion. It'll be interesting to see how it affects the GSEs because they're buying high, they have to use their cash on hand, they might even have to issue debt. It fundamentally changes the economics of the GSEs, especially if they're planning on doing an IPO. So many people are wondering whether this delays the IPO. They also have to hedge appropriately or they're going to get in trouble. They got in trouble before the great financial crisis with their purchases. So it's definitely going to be something you want to watch. There were the other thing that was announced right before Davos in an executive order was a ban of institutional investors from owning single family homes. This is more of an issue in some areas, Phoenix, for example, but it overall should have a very small impact. The vast majority of investor-owned homes are small, less than 5, and another 6% are like between 5 and 10. Only 2% are more than 1,000. A lot of it will depend on how the Treasury defines it. They have 30 days to define who is the investors, but this should have a fairly small impact, especially given that there's some evidence that investors are already selling some of their existing stock.
And as you
NBA
said,
has a
they got to define that number, but it seems like they're leaning towards the 1,000 and above investor as the large investor.
right.
That's a lot, and that's less, like you said, it's 1% of the market.
Yeah.
95% of the market is less than 10 properties. So
Yeah. And then it would be interesting if they could think of incentives to get those folks who maybe wanted to sell, people who came into a property, people who wanted to Airbnb it or whatever, and it hasn't worked out. But if you sell an investor property, you pay full capital gains. So targeted relief for smaller investors to sell to a owner occupant might be an interesting idea.
yeah,
There another idea that was on the table that didn't come out was to allow homeowners to withdraw from their 401k and other educational accounts to make a down payment. Supposedly Trump himself, as reported in the press, had reluctance to do that, especially because the stock market's doing so well and many people have 401ks. So you didn't see that announced. There's a laundry list of things that the NBA has asked for. Many of these, the likelihood is somewhat in doubt. But MIP cut is number one. The FHA just announced that they had a substantial operating surplus. They're like 6 times the minimum requirement in their capital reserves. The problem with the MIP cut is their delinquencies are rising. They just did a MIP cut in 2023, and I think FHA really wants to see how that sort of affects the long-term stability of the fund before they make another MIP cut. LLPA reductions on the GSE side might be more likely, especially for certain types of loans, refis, think. But that too affects the bottom lines of the GSEs right before an IPO. It'll be interesting to see what they do there. LO comp reform is something we can talk about. It would require the Bureau to do. The three things the MBA has always asked for is an exception for bond program, HFA loans, the ability to ding comp if there's errors made, and number one is a competitive exception. So if a buyer comes in there and has a competing offer and the LO can voluntarily lower their compensation to match that. The problem with that is how you document that and how it's implemented, whether there's controls for fair lending impact. It can be much more complicated than it seems on first place, and many consumers don't shop, so you might see sort of interesting dynamics there.
Did you see
They want
anything
to
really big coming out of the NBA requests other than what you just talked about, or
the one I think has the best chance is actually some sort of streamlined refi exception to QM. So that was something that's been discussed under Republicans and Democrats. As you know, FHA and VA, they have these streamlined refi programs that have been very popular and very successful for many borrowers. The GSEs can't do that. And if you are performing for a certain period of time in your current loan and you're lowering the payment, it's a no-brainer that maybe you should be able to get a streamlined refi, and that'll be meaningfully impact for those who are, sitting at 6.5 and above. So if they could do that in the near future, that could have a big impact. I believe, based on my conversations with CFPB staff, that's something that's on the table that they would work on. So that's something I think you can see. We have the State of the Union coming at the end of February, so that's probably the next chance to see if there's any other things coming through. The way to
you
think
had the
about
one on here with the condo financing reform. I heard that Fannie and Freddie were close to getting some of that completed already. Any comments there?
Yeah, no, I've heard the same thing. So, and that's something that I think needs reform. The process has been a little clunky of late. I myself live in a condo. It's a necessary part of the affordable landscape. I think when they're thinking about affordability, some of the ancillary costs might be an area where they can get a lot of bang for the buck. The GSE, they have an appraisal waiver process, which allows them to waive appraisals in certain cases based on their statistics. That's an easy way for a consumer to save $500 or more. They're doing pilots on title insurance, so there are ways I think you'll see money being saved. One thing we didn't mention, but we should mention here, is credit score reform. The MBA is making a big push to say, instead of pulling 3 bureaus for certain loans, say over 700, can you just pull one? Given how much the credit scores have increased in the last few years, everyone on this call knows this. I think there's a strong desire to develop some competition between the 3 bureaus. Right now, you have to pull 3. Even if one of the 3 is less accurate, there's you can't shop for accuracy, you can't shop for price, you have to pull all 3. And so the NBA's effort there is to try to introduce the beneficial of competition to the 3 bureaus. Hopefully that'll contain costs, and it might even improve accuracy. The argument against it is that, sometimes there is different information to the 3 bureaus, but as we just talked about, they have no incentive right now to make sure they're the most accurate because they have to pull 3 no matter what. So we'll see what comes down the pike there. But the NBA is making a strong push to have some reform on the requirements there. Also, if they could update the scores to Vantage 4 and FICO 10T, that would be probably a gain for some consumers. We're still using classic FICO, which is, a much older, outdated model. Next slide. So states are now stepping into the fray now that CFPB is back, and you see it on 2 levels. You see both state laws coming down the pike, left and right, and you see state regulatory action much more aggressively than we have in the past. And I think this is going to be, for IMBs like Newrez, this is a lot of what we're looking at is you see these laws, they come out of nowhere. There's a lot of activity on the state level. I just listed some here. So California passed a zombie foreclosure law, which basically was so broad that it might affect all second liens in the state of California. And it was one of those ones that, the state NBA did a good job tracking and trying to sort of fight against in the legislative session. And it came out of nowhere in the final budget and was passed. There's litigation about it right now. Other states are considering the same thing. Connecticut, by the way, has a version of the law that's much easier to implement for at least servicers like Newrez. So that's one thing. The other big thing that'll affect IMBs is CRA laws. Right now, Massachusetts, Illinois, and New York have IMB laws on the book. California, New Jersey, and Pennsylvania have laws that are under consideration. These would basically measure IMBs for some of the same things banks are measured for, how many loans they make to LMI borrowers, whether they do have partnerships with housing counseling groups and the like. Now, ironically, IMBs already do the vast majority of LMI lending. If you look at an FHA or VA loan, chances are you're going to get it through an IMB. So it's interesting that that's the thing, but it seems like a ship that's going to go no matter what. The other thing on here is New Jersey has a disparate impact law that's very interesting to watch. If someone proves that there's a disparate impact, it basically shifts the burden and says that the lender has to prove that there's no less discriminatory alternative. And before you be able to have a business justification, you could say, well, I have a credit score overlay because I don't want to have the cost of servicing delinquent loans. That may no longer be an acceptable sort of excuse out of the disparate impact. So that's another one that there'll probably be litigation over. I just list a handful of other things that are coming down the pike. Many states have their own servicing laws, many of which are regulating junk fees. You see AI, which is becoming increasingly used by all lenders. Both Colorado and Michigan has released guidance about how they want to see AI used. So did Freddie Mac, interestingly enough. And then the last one is UDAP, which is an authority the Bureau used quite liberally. You'll see that in states like California, New York. New York just passed theirs and the governor signed it. So states will be the primary regulator for IMBs. It's often a chaotic process when you're examined by a state. You have these multi-state exams where they don't all agree with each other, where you might have to end up trying to settle with multiple states at once. The way the CFPB used to do an exam is they do an exam, they find a problem, you fix it, you make any consumer whole, and then only if there was like a problem with the remediation or they came back and found the same problem would it go to enforcement. Now, often with these state exams, you're left paying a fine no matter what, and it sort of creates a different dynamic for supervision, which is less about creating the best outcomes and more about this sort of revenue generating thing for the states. States to watch are California, New York, Washington, Illinois, New Jersey, Massachusetts, Nevada, Oregon, and Maryland. But any state can take action. I mean, I think all of you perhaps noted the Ohio case against UWM. That's a red state. Their AG filed suit because the brokers were referring the vast majority of their clients to one lender, and they used state law for that case. So states are going to be where a lot of the sort of risk in operation and lending will come from, over the next couple of years. Next slide.
So one of the questions, Mark, that were in the chat that I saw, and we kind of chatted about a little bit, is just more of it moving to states because maybe the CFPB isn't taking as much action. Do you see them having funding issues at all? Somebody was making a
Yeah,
comment.
it's absolutely true that states are not as well funded as the CFPB, and it also creates weird incentives
I
because
was going to say
that
that's where
that's
some
why
of the
they
finding comes from.
right they need to kill what they eat what they kill. So there's this sort of incentive to find problems, incentives to raise money, incentives to fund their operations. Number of states have also increased the sort of the licensing fees for operators in the state to sort of provide funding. So it's going to be an interesting thing to watch. Totally
And
agree.
it seemed to used to long ago, because I've been in the business a long time, that it would waterfall as well. If you'd find an action taken by one state, then the other states would then start filing similar,
Yeah.
uh, you know, complaints. And so it's just going to be interesting because that would be one of the comments that I would make and would love your comments on is even though the CFPB may be shrinking, I think having a strong plan in place for controls are important because now you have 50 states monitoring you, trying to drive revenue, and I think you brought up AI and how they're putting rules around AI, but they also may use AI to do more auditing. I don't know if you have an opinion on that as well, because
I Totally agree. Yeah, I mean, I couldn't agree more. I think the sort of lesson, if you take one thing away from this whole presentation, is the risk is different, but it's still there, and if in many ways it's more fragmented and harder to manage. You have states, you have private litigants, and we can talk a little bit more about that. There's just this week, two separate lawsuits have been filed against Rocket, one for a RESPA case, one for privacy laws. Loan Depot has an LO comp case. There's been TCPA lawsuits against UWM. So I think private litigants who can enforce almost all the TILA RESPA laws that the CFPB enforced will step into the fray. You even have some former CFPB people forming their own sort of private litigant nonprofits to sort of pursue this litigation. The states are there. And also don't forget that if there's an election in 2028, and that goes the other way, the CFPB can look back and find violations that over the last several years, including 2026. So I think the risk is still there. The need for compliance has never been stronger in some ways because it's so fragmented. And your point about AI is right on the numbers. If loans start to default, which could happen depending on the economy, people will look for ways to push back the loans. The FHA used the False Claims Act, the GSEs use their buyback authority. And before you'd have to sort of manually review the loans and find any flaw. Now you can run a program and in 10 seconds find any violation of their policies or procedures. And the ability to push back will never be easier. And I know for a fact that the GSEs are developing those tools. So it'll be very imperative for lenders to make sure they also have a grasp on what exactly is going on with their books.
Yeah, I couldn't agree more. Like FHA's rule used to be we audit a percentage and then extrapolate that and apply it to your entire book. Do they even have to do that anymore, right? At some
No.
point, they can just audit it all.
Yeah, the one thing that'll disappear at some point is sampling because it's all going to be 100% and because computers can do it. I mean, the AI models can process more information than any auditor ever could in the old days. These are our big sort of questions, takeaways for 2026. One is what executive action will there be beyond the two that we've named on the Trump thing? Will the Senate House bills pass? That's something we're very looking for. Not on here, but something to track is insurance costs. There was just an article today about how insurance costs seem to be moderating, but insurance costs increasingly are becoming a pain point for consumers. It's going to have to be something loaded into the conversation on the front end so consumers don't get into trouble down the road. It's an old statement now, but you can get a 30-year fixed rate mortgage, but you have sort of an arm with your insurance costs these days. And the same is true for property taxes and HOA, which increasingly are taking up a bigger share of the payment. What will happen with the CFPB? If it's shut down, we can't expect any changes on LO comp, on the streamlined QM we talked about, on servicing or RESPA, all of things the industry sort of wants. So if they're not functioning, we won't get changes that you sort of want and probably want this administration to do. And then I talk about the 2029 question there.
What would be the way that if the CFPB kind of didn't have funding, that rules would get passed? Because the old way would probably be written. Takes a long time. I don't
Yeah,
know
I
if
mean,
you have an opinion on how that would function.
you mean if the CFPB
Even like
could,
getting rid, like people, they want to change LO comp and the CFPB is not functioning. The LO comp rules in place. How would that change?
it can't. I mean, the way the rulemaking goes is when a law is passed, LO comp is written into Dodd-Frank, and it gives the authority to the Bureau to change it. States can enforce it. States can add their own LO comp law, but the only one who can modify the federal LO comp law is the CFPB, unless another law by Congress is passed and moves the authority to another agency. So you need the CFPB to be functioning to make changes, and I think that's something that and you I think it'd behoove us all to sort of talk about if the bureau is still going to be around, how do we make it less subject to these political winds? How do we keep it more in the even keel? I mean, having been there for 7 years, the dramatic whipsawing effect was hard to live with and hard for the industry, and maybe even doesn't serve consumers. It would be better if we could find a way to sort of create a balance in the CFPB so it could be a normal, established part of the landscape. We're not there yet, and I wish there was more conversation around that as opposed to the on-off switch that we're sort of talking about now. What happens with credit scores? So the Vantage Score announcement was last July. As of this point, not many people are delivering Vantage Score loans. 10T is not being used, even though they were just approved. So will either those come in? Will there still be a tri-merge? Will the NBA gain traction? I think these are all questions that a lot of people are asking. And then a big, huge question is what will happen with the GSEs? Will an IPO occur? What effect will they have? Will they have an incentive to take more market share, to, for instance, maximize the revenue, to deliver for investors? Will they push into markets, non-core markets like second homes are on there? What will happen with this MBS portfolio? They've lost a lot of the folk. I mean, when they did have a portfolio, they had a lot of people there who are no longer there, who used to do all the hedging and the like. So it'll be interesting to happen. We already talked about private litigants and AI. So those are the two things. So these are all areas that I think we're going to have to watch closely in 2026. It is crazy chaotic, and it is harder for you guys to do your jobs than ever before in some ways because it's such a diffuse environment. I think that's the end of it. Maybe the next slide is our contacts.
It is. I know we had a couple questions, and I don't even know if we would have it, but some of them were around tax code or portability of mortgages. It seems like all of that just falls under what Pulte and others are talking about, and whether or not they'll push through things. I don't know if you've gotten any inside color from the people you hear
So
from.
yeah, the two sort of ideas that Pulte floated at different times are 50-year mortgage, which is receded in talk. I mean, I think you all know the reason why not to do that, which is, it wouldn't actually save you that much money and you would never build equity. The other one is the portability, which makes it incredibly complicated, especially for uh, investors who perhaps invested with one set of assumptions. I saw a question about ECOA there in the chat. What's it say exactly?
I didn't see that one. I'm trying to scroll down.
Q&A. I'm going to take a look myself.
Oh, yeah. One of the other questions, do you see having to be licensed in a particular state to originate in that state will ever go away? I don't
No,
see that changing.
no.
At least for residential lending, you have other types of lending, business purpose lending that has different rules, but not for conventional lending.
Here's one in the chat part. Any advice you can give us for IMBs for implementation with the new ECOA changes? My general advice for IMBs and other lenders in general is just steady as you go with compliance. Make sure you get a sense of how you're lending and how you're not lending. Several states have their version of ECOA. Disparate impact is still in the Fair Housing Act and in case law. So, and that rules mortgages. So I think you should keep doing everything you're doing around HMDA, everything you're doing to sort of know who you're lending to, who you're not. And that also makes good business sense. I mean, if there's markets you're not fully serving, that's a business opportunity, right? So that's always been my case for fair lending is more money is better than less money. So try to make sure you can find the markets you're not fully serving, and HMDA could be a tool for that. Has been reducing or limiting capital gains taxes for investors selling single-family homes to owner occupants. That comment in the chat is something I talked about briefly. I think it would be a great idea, perhaps more impactful than the big, huge institutional investors. But if you create a capital gains exception for someone who sold their smaller landlords, that might be something that could actually have a meaningful number of homes to add it to supply. Let me check to make sure I'm not missing any other chats here.
Yeah, in the Q&A, there's some stuff around if we wanted to expand on the condo things, we can either get that out in the Q&A, FAQ, or if you have any comments on it, you can add to them.
The condos, it's going to be tough. I mean, obviously, some markets like Florida, condos are really struggling because of the reserve requirements. And having lived on a condo and been dragged onto the board, it's a never-ending nightmare, right? But it is, like I said, when we bought our home, it was that was the place we could afford. So it's a key part of the sort of infrastructure. And I think they have to, condo insurance in particular, you think the homeowner insurance market is complicated? Getting insurance for your condominium, your master insurance policy has become increasingly expensive and complicated.
Do you see any insurance reform coming down the pike? As you said earlier, it's such a big part of PITI. Some
Yeah.
states, it's more than 50% of the housing payment, especially with some of your aging seniors. It becomes a big part of the affordability of their home.
Yeah, I totally agree. The problem is it is state regulated, and the states differ in their approach to how they allow insurance companies to sort of set fees. You clearly can't restrict. I mean, insurance companies know when they're making money and they're losing money. And there was a great Wall Street Journal article that talked about how some states they've been losing a lot of money in, and you see the state start to pull out. I mean, the insurance companies start to pull out at that point. So it's a tough road to hoe. The only way ultimately we get ahead of this is two things. One is hardening and sort of like making our homes more secure, but that's expensive. And two is different choices on the front end, making sure when you're buying your dream home, it's not in one of these areas that have higher risk. And you can't rely on the flood zones to tell you where the risk is, we saw from Helene and other disasters, Harvey. The flood risk is often outside the flood zones, and in Helene, it was mud risk and other things in Asheville. Other things in the questions or chats?
No, just around, there's some stuff that's starting to pop up around. Do we see any more flexibility coming out, whether it's streamlining loans, whether it's FHA, VA, or Fannie? And then ADUs, right? You were talking earlier about inventory. ADUs have been worked in for one ADU, but we're starting to see multiple ADUs in markets. Anything you see coming down the pike since more and more states are opening up ADUs, on whether
Yeah.
or not you see
So
anything
the
changing from
ADUs
the
are,
agencies?
yeah, they have to create more flexibility in the underwriting requirements, I guess, because it is sort of hard to say what income you can count for ATR purposes on an ADU. Like if you've never rented before, can you use do proxy rent as part of your income? It's a complicated question, but I think all the agencies are looking at it because ADUs are increasingly part of the puzzle here.
Yep. But
And
but I think that was answering on most, Mark. I know, we're wrapping up a little bit early. But as
well,
you read through more of the questions, I'll continue to kind of transition over to Will.
yep, and I'm also hopefully the contact information. I'm willing to answer any questions offline. My phone number and my email was on there, mark.mccardle@newrez.com. Newrez wants to be a partner for you guys and a resource. So, and you guys know better than I do what's going on out there in the field. So I welcome any conversations with any folks on this call afterwards. So feel free to reach out, mark.mccardle@newrez.com.
Yep.
We're open 24/7, just like McDonald's.
Well, I appreciate it, Mark. You bring a wealth of knowledge with your history, and I know I'm seeing a lot of comments in the chat that people are very thankful of some of the information. I know we do these webinars on a regular basis, and so just going to kind of transition over to you, Will, to kind of chat about not only this one but future ones.
Yeah, of course. Thanks, Don. First of all, I want to say that, Mark, I'm glad you're on our side. So, and Don, Mark, both of you, lucky to call you colleagues, to have you at Newrez. This was great, content packed. And I know everyone probably who attended felt the same thing. Very helpful. I do want to transition to start discussing our next webinar. Hopefully, everyone who attended found this very helpful. I know it was brought up AI. So, everyone, that's the talk of the town, right? Everyone's talking about AI. And we know AI is rapidly transforming our industry. And I'm happy to say that Newrez, I feel like, is leading the way. And as we go through this webinar series, Winning in Winter, we're excited to have our final edition of the series be focused on AI. So it's called Sales Transformed: AI is Your Competitive Edge. And we're going to have a few presenters from the Newrez team: Brian Woodring, our Chief Information Officer; Jason Singh, a branch manager in our retail division; and then also Dustin Ashley, a sales manager in our DTC purchase division as well. So that's scheduled for Wednesday, March 11th at 2 p.m. Eastern time. I'm going to drop the Zoom link in the chat. So would love to have everyone attend that final edition of the Winning and Winter webinar as well. And yeah, I should have mentioned earlier, I'm the Senior Director of Talent Acquisition at Newrez. We are always looking for talented people. I know we have several broker partners. We may have some other folks that could be exploring opportunities. Feel free to reach out. Following this call, we are going to provide some contact information in the form of a fact sheet, and there will be contact information listed there as well. So, Don, Mark, any
Yeah.
closing comments?
I would only close with join us for our AI webinars. You heard it's not whether or not you even want to adopt it. It's whether your competition is going to adopt it or maybe your regulator. So join us for the next one. Again, thank you, Will, and thank you, Mark. Great day.
Yeah, my pleasure. I hope you guys stay in touch, and I look forward to doing this again because I'm sure it's going to be a whole new environment in another 4 months.
Thanks, everyone.
Yeah, thank you so much.